Good evening, friends, and welcome to another video by the Option School. This is your friend Pradeep Singla. In this series, where we are talking about different strategies, today it's strategy number 6, which is covered call option strategy. This is a very special strategy because all the other strategies have a very short term impact. But if you see covered call, two things are there. It's having a very long term outlook for a trader and gives you profit for a very longer period also. Secondly, it can be done very passively. Let us see the final points of covered call, and I will be asking you one question also, depending based on whatever we have discussed in the video. Now, it's a very popular strategy for investors to generate some additional income from their stock portfolio. So, if you are having some stocks and you are buying those stocks here, one thing is very important. If you are buying those stocks in a lot size, so covered call strategy can be done only in F&O stocks. If you're buying the stock in equivalent to a lot size, suppose the lot size of the stock is 500 stock units. So if you're buying that stock in 500 units, then only you should do covered call to generate some extra income on your stock portfolio. So what exactly is the trade? Trade is that okay, you hold the stock, you are keeping that one lot of stock with you. Against that one lot, you are selling one call. So whatever is the premium of that call, that is going to be your profit. So that is why the sold call is covered by the actual purchase of the stock. For example, if you want to do it in Nifty, so you have one lot of Nifty with you. Like Nifty do not trade in cash, so you can have one lot of Nifty ETF. There can be Nippon ETF, there can be a SBI ETF, whichever ETF you select. So one lot of Nifty ETF you buy, and against that you sell a call. So one lot you will buy once, and against that you will keep on selling the call every month. So this becomes a strategy wherein you are buying a property and you are getting a monthly rent on it. So if you see the real estate landscape in India में अगर आप बात करते हैं तो अगर एक property you have purchased which is worth, let us say उसका worth है 1 crore rupees, you will get a rental income of not more than 2.5 to 3%. You will get for a property of worth 1 crore rupees, you will get something like 25,000 rupees rent. So 25,000 becomes something like 3 lakh rupees. Plus you have certain other expenses, you have to pay certain maintenance, you have to pay some municipal taxes, etc. Let us ignore all that. वो सब अगर छोड़ भी दें तो ultimately you are getting around 3%, 2.5%, 3.5%, depending upon different properties, annual rent on that property. Covered call is similar to buying a property and giving it on rent, where you can get 1.5 to 2% rent on monthly basis. In real estate, it is 3% on yearly basis. Here it is 1.5 to 2% on monthly basis, which boils down to something close to 18 to 24% on yearly basis. So it's a great strategy even for people who do not want to see the markets on day to day basis. Only thing is you need to set up the process. आपको process set up कर देना है so that your account is working on that, and it is very similar to buying a property and giving it on rent. जो आप स्टॉक खरीद लेते हो या अगर आप निफ्टी खरीद लेते हो, दैट इज अ प्रॉपर्टी in which you have spent some money. We will see how much margin is required, and the money you get by selling that call is your rent, right? So that is a monthly rent which you will get. Obviously there will be many questions in your mind, but just hold on, I will clarify all those questions also. So when to do, I'm saying it's a very long-term strategy. You do not do a covered call when you want to be in that stock for a month or 2 months or 3 months. So I'll say it's a long term. Long term means you want to hold that thing for 5 years, for 10 years. So you do not invest in property for a month or 6 months. Obviously, you invest in properties for a long term. So if you want to keep that stock, or for that matter, index for excellent returns in all the three scenarios, when the value of the index is going up, or it remains sideways, or even if it is going down, in all the three scenarios you get very efficient returns. I will show you how much returns do we get when market goes up, or when market remains sideways, or even when market goes down. Now, first thing to note, what is the margin requirement? Now, this is a kind of a little bit of hurdle for most of the retail traders when it comes to the high margin requirement in covered call. Now, again, since you are buying the full lot of the stock or the index, so जो भी उस stock की value है, if the stock is, let us say, priced at 2000 rupees and its lot size is 500, so then you need to invest 10 lakh rupees because you have to buy the stock. Similarly, uh, in case of Nifty at present rate, you can assume that, okay, if Nifty is, let us say, at 18,000, then you have to buy the full lot of Nifty, which will cost you around 9 lakh rupees. So 18,000 multiplied by 50. So you need to buy ETF units equivalent to 9 lakhs. So that generally boils down to 5,000 units of any highly liquid ETF. So 9 lakh rupees to acquire one lot. Against this 9 lakh, you will be selling a call every month. Now, biggest advantage if you're doing it into a good quality stock, or you're doing it in Nifty. In Nifty, at least pledging can be done. So you have invested this 9 lakhs, but out of that, 90% of margin will be given back to you if you pledge this all Nifty Bs or whichever ETF you buy, pledge it to your broker, and he will give 90% margin back to you. Now this 90% margin you need to use, right? You need to use for your short term trading strategies. Covered call will be a long term trading strategy if you want to take benefit of both short term as well as long term. But with the recent ruling, the biggest problem is now you cannot use this 90% margin just like that. Now the latest development says that, okay, whatever is the margin requirement, whatever is the margin available, you have to add equivalent amount of cash to use that margin. For example, in this case, you have given 9 lakh rupees to the market. Let us say they are giving you 8 lakh as margin. You cannot use a single paisa of that 8 lakhs unless and until you add some cash. Now if you add, let us say, 5 lakhs of cash to your account. So what will happen? You will be able to use that 5 lakhs plus 5 lakhs of margin also. So overall, you will be having 10 lakh rupees with you to be used for any other option trading strategy as a margin. So 5 lakhs cash, उसका जो भी इक्वलेंट होगा उतना ही मार्जिन आप यूज कर सकते. If you add 3 lakhs, so then you will be able to use 3 lakhs cash plus extra 3 lakh margin. Out of 8 lakhs margin, only 3 lakhs will be available to you because that is the cash. So if you want to use the full margin, जो कि यहाँ पे in this case जो कि आपको 8 lakh rupees मिला है, let us say, then you have to add 8 lakhs cash or cash equivalent to use full 16 lakhs. So 8 lakhs cash हो जाएगा, 8 lakhs का margin हो जाएगा, and in that 16 lakhs you will be uh, able to create all the other option trades whatever you want to do. So practically you require around 16 lakh rupees. But if you see, out of that 16 lakh rupees, out of that 17 lakh rupees, 9 lakh for buying Nifty and another 8 lakhs cash. So out of 17 lakh rupees, covered call will absorb only 1 lakh. Balance 16 lakhs is available to you as a margin, right? But if you say, uh, can I do covered call in only 1 lakh rupees? That is not possible. So that is the biggest hurdle, that, okay, you need to have a slightly bigger account so that you are able to take the benefit. But once you have taken the benefit, you are not spending that much money on covered call. You are spending only, let us say, 1 lakh, or maybe for selling a call, another 1 lakh. So आपका जो covered call का strategy per se, it will consume only 2 lakh rupees. But to set up the process, and if you want to use that margin also, you need 16 17 lakh rupees. But if you do not want to use margin, you say, okay, I'm very happy with only covered call, then no need to add cash. Then only 9 lakh rupees, or maybe I can say 10 lakh rupees are required if you want to do covered call in Nifty, right? Hopefully, I have clear. So, what is cash equivalent? Cash equivalent, generally, if you buy liquid Bs or sovereign gold bonds, they are treated as cash equivalent, or you can keep cash also. So, after selling a call will require another 1 lakh rupees. So, total we have given, let us say, 17 lakhs to the market. 9 lakhs का हमने निफ्टी खरीद लिया है, 8 लाख हमने कैश इक्विवेलेंट डाल दिया है. 17 lakhs में से एक लाख का हमारे को निफ्टी का नहीं मिलेगा 10% margin. So we still have 16 lakhs. Out of that 16 lakhs, another 1 lakh will go in selling a call. Remember, covered call mein you need to sell a call every month, and this call will involve at least 1 lakh rupees of margin, तो वो वहां लग जाएगा. उसके बाद we have 15 lakhs to use for our other strategies. Now if many times a lot of traders come and they say, sir, what if this kind of capital is not available, can I do not trade in covered call? So there are few options if you do not have this kind of capital. So you can use futures instead of using Nifty ETF. Uh, so future will cost you, one lot of future will cost you 1 lakh or 1 lakh 20 30,000 rupees. But only problem is, especially nowadays, what we have seen that okay, future is having a huge premium. So even till last week of the expiry, futures still have premium of 70 80 rupees. So that 70 80 rupees will go down the drain. So that is not a right strategy use to use covered call with futures. Although it will drastically reduce the margin requirements and the capital requirements. Better method, we call it as poor man's covered call, wherein you are not able to buy the ETF. So what you do, you buy a deep in the money call. Even if you buy a call which is costing you, let us say 2000 rupees, or even if 3000 rupees. So if the call is costing you 3000 rupees and it is not having any significant premium, generally very deep in the money calls will not have extraordinary premium. They can still have 20 30 rupees premium. So if you're buying deep in the money call which is worth, let us say, 2500 rupees, so in that case you are able to create something similar to covered call in 1 lakh 25,000 rupees. So instead of 9 lakhs, you are spending 1 lakh 25,000 rupees, plus you need some more money to sell a call. Generally, when you have purchased such a deep in the money call and you're selling at the money or slightly out of the money call, you will not require any extra margin. So that is one aspect which can be that is one way of doing covered call. Instead of buying the Nifty ETF, you can buy a deep in the money call, and based on whatever is your profit every month, I generally suggest that okay, you keep on accumulating. Suppose on a given month, in this poor man's covered call, you are able to make, let us say, 10,000 rupees, very minimal, just 200 rupees worth of call, and that becomes zero. So you're able to make 10,000 rupees. So to start the process, start buying Nifty ETF for that 10,000 rupees. Slowly, 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 you will be able to accumulate, and one day you will be able to do, maybe not very far away, but maybe in next 24 months you will be able to accumulate the full lot of Nifty, and you can do the actual covered call also, right? So this is the solution in case you do not have that kind of capital at your disposal. Now, what is the profitability? Now, in the past, we have seen that a profit of around 15 to 24% is achievable in Nifty covered call. I'm not talking about stock covered call, because stock covered call definitely have some risk element to it. The stock can really go down and you cannot do anything. But in Nifty, you can do a lot of things, and if Nifty goes down, then also there will not be any problem. And additionally, in addition to this 15% to 24%, which is a yearly return, not a monthly return, trader is able to get more returns from the available margin. So you have set up the covered call for Nifty, and now you still have 15 lakh rupees. Even if you're able to get, let us say, 1% through that, so you can get additional 12%. If you get 2% through that per month, you get additional 24%. So generally it has been seen that if you are setting a covered call and using the available margin wisely, you are able to fetch somewhere close to 30 to 40%, depending upon how the markets behave during the year. So this covered call becomes the base tool for generating huge passive income, because here you need not do anything on day-to-day basis. Only on the expiry day you will see what has happened to your call which you have sold. If it has already become zero, you need to sell the next month call. If it has not become zero, then also you need to sell the next month call, and you have to roll up your call. In any case, your Nifty ETF is generating capital for you, profit for you, right? So what we have seen, if the underlying, or if you say Nifty goes up drastically, so by selling a call we are capping our possible profit also, right? क्योंकि हमने उसके ऊपर का एक कॉल बेच दिया है, तो जो स्टॉक को या निफ्टी को ऊपर जाना अनलिमिटेड प्रॉफिट होना था वो नहीं हो पाएगा, क्योंकि देयर इज अ कॉल विच कम्स इन बिटवीन, एंड आफ्टर अ पर्टिकुलर टाइम the profit on the stock will get nullified from the loss in the call, but the gap between two will be your profit. So what we have seen in many cases, like in previous year when market suddenly went up from, let us say, 11 12,000 to 17 18,000, you are not able to capture the full up move of the market. But yes, you're still able to capture with the right process 75 to 80% of the up move. Second advantage, if underlying remains sideways, so if market remains, let us say 18,000, and 18,000, say it goes up 200, 300, 400 points, comes down 300, and it remains within 1,000, 2,000 points, then also you are able to make 15 to 24% returns. Otherwise, you can say that, okay, why not I buy the stock and just wait. But in that case, if in case the stock doesn't move up, you're not making any money, and there is obviously an opportunity cost to everything. But in covered call, you will definitely make money even if the stock remains there only, or if you have done it in Nifty. If Nifty remains there only, then also you're getting huge return. 24% is a excellent return. And still, whatever you will be getting from short term options by using that 15 lakh rupees, that is extra. If underlying goes down, 15% is still achievable with proper hedging of overall trade, which this hedging, what I am talking about, this is possible only in Nifty. This is not possible in any stock in Indian context. So that is why doing covered call in Nifty makes much more sense. Now, what is the right phrase? We need to follow a well planned process to take full benefit of the strategy. In general, you can say covered call is just you buy one lot of stock and you sell a call of that. It's a two leg strategy. General sense में, अगर normal sense में देखेंगे तो two leg strategy बनती है. But if you want to take the complete benefit of it, if you want to completely hedge it against any big fall, etc., 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 it's not a two leg strategy. We need to add certain legs so that everything is pretty well hedged. So generally, what you do in Nifty, you try to buy a very long term put option to hedge your uh, ETF, and plus you need to add another leg, so as in case market makes a very big up move, you are still not losing an opportunity to make extra profits. So outlook is very very long term. And second point, trader also uses the available margin very effectively for his monthly or weekly strategies. We have a strategy members group, and how a particular strategy is performing in a previous month, we are giving you the back testing of many strategies already. Short straddle, short strangle, iron counter, iron butterfly calendar back testing results for November, for December are already published in this group. And you can access this through the playlist. There is a different playlist for strategy members group. So if you are interested, please go ahead and join this strategy members group, because after a few months, what you will have a full complete battery of many strategies whose back testing is available for November, for December, for January, February, and then you will come to know कि कौन सी strategy मेरे को suit करती है उन strategies को देखने के बाद. I hope all the strategy member group are members are enjoying the back testing. We have already uploaded, if I'm not wrong, 9 to 10 videos in that. Now another thing is, let me ask you one question. Please write it in the comment section and let us see. And I will try to reply to each and every question answer. What is the capital required for doing poor man's covered call, which I have already explained. So for right portfolio allocation options, so you need to have covered call, you need to have some other strategies to use those 15 lakh rupees also. There is a free webinar available on TOS app. There is a portfolio allocation webinar which tells you that, okay, how you need to allocate your funds, how much you should give to covered call, how much you should give to strategy A, strategy B, strategy C. And this webinar, as of now, we have kept free for all TOS app users. Although when you go to that site, it shows you that, okay, there is some price, but no need to pay that price. You can just go there, click there, and check the free content inside without paying anything. So you will be able to access this portfolio allocation webinar. After going through this webinar, you will come to know, okay, how covered call plus some other strategies will help you in building up the overall wealth. So download TOS app. The link is given in the description. And once you are in the app, you can see this portfolio allocation webinar without any cost. Don't pay anything. Although it says some money, but for keeping anything on the app, we need to have some price. So we have just said 9.99, but that is not required to be paid. You can see it without any cost. So hopefully you will like that portfolio allocation webinar, and that will change the overall perspective of how you need to trade in option trading strategies. And if you are not the subscriber of the channel, please go ahead and subscribe the channel, and do like this video, so that uh, we come to know that okay, what kind of content you people are liking, and write your answers in the comment section. See you in the next video. Thank you.